Picture this. It's late February 2026, and you're scrolling through your phone when a notification stops you cold. Strikes on Iran. The Strait of Hormuz, the narrow stretch of water that carries 1 out of every 5 barrels of oil the world uses every single day, has just gone dark. Tanker traffic, that normally runs somewhere between 80 and 130 ships a day, collapses to near zero within 48 hours. Within weeks, gasoline in America jumps by almost $1 a gallon. And headlines everywhere start asking the same panicked question. Is this the moment the dollar finally loses its grip on the world? Meet Marcus. Marcus trades commodities for a mid-sized fund in Chicago. And until that week in February, his job was mostly about spreadsheets, weather patterns in Texas, and OPEC meeting transcripts. Now his screens are full of something else entirely. Insurance premiums on tankers spiking overnight. Chinese-flagged ships suddenly the only vessels still moving through Hormuz. Reports that some of those ships are paying transit tolls to Iran, not in dollars, but in yuan, and in some cases, even in crypto. Marcus has read about the petrodollar system his whole career the way you read about something that's just always been true, like gravity or the tide. Oil gets priced in dollars. Countries need dollars to buy oil. The world needs dollars, full stop. But in the spring of 2026, for the first time in his career, he starts wondering if that sentence is still as solid as it used to be. To understand what Marcus is watching unfold, you have to go back more than 50 years, to a deal that was kept quiet for decades. In 1944, representatives from 44 countries met in Bretton Woods, New Hampshire, and built a new global financial order. The dollar was pegged to gold at $35 an ounce, and every other major currency was pegged to the dollar. For nearly 3 decades, that system held the world together. But by the late 1960s, the United States was running large deficits, fighting an expensive war in Vietnam, and printing more dollars than it had gold to back. Foreign governments started showing up asking to trade their dollars for actual gold, and the United States didn't have enough to give. So in August of 1971, President Richard Nixon did something that shocked the world. He closed the gold window. The dollar would no longer be convertible into gold at a fixed rate. Practically overnight, the entire post-war monetary system that investors, central banks, and governments had built their strategies around simply stopped existing. The dollar was suddenly floating free, backed by nothing but trust in the United States government. That's a dangerous position for a currency that wants to remain the center of the world economy. And then, just 2 years later, an opportunity appeared, wrapped in a crisis. In October of 1973, Egypt and Syria launched a surprise attack on Israel, starting what's known as the Yom Kippur War. The United States backed Israel with weapons and aid, and in response, the Arab members of OPEC slapped an oil embargo on the United States and its allies. Oil prices didn't just rise, they quadrupled in a matter of months, from around $3 a barrel to roughly $12. Gas lines stretched around city blocks in America. It was chaos. But out of that chaos, U.S. Treasury Secretary William Simon and Secretary of State Henry Kissinger began quiet negotiations with Saudi Arabia. The deal that emerged, not formally signed until June of 1974 and not fully understood by the public until documents surfaced decades later, was elegantly simple. Saudi Arabia would price its oil exports exclusively in U.S. dollars. In exchange, the United States would provide military protection and access to American weapons. Saudi Arabia would then take its enormous oil profits and recycle much of them back into U.S. Treasury bonds, effectively lending the money straight back to Washington. By 1975, every OPEC member had fallen in line with the same arrangement. This is the birth of what people now call the petrodollar system, and it did something remarkable for the United States. Because oil, the single most important commodity on the planet, was priced almost exclusively in dollars, every country that needed oil, which is every country, needed to hold dollars first. That created permanent, structural, built-in demand for the American currency, no matter what the Federal Reserve did with interest rates or how large the U.S. budget deficit grew. Economists sometimes call this America's exorbitant privilege, the ability to borrow cheaply, run deficits other countries couldn't dream of running, and project financial power across the entire globe, all because the world simply needs dollars to keep functioning. For 50 years, that privilege held remarkably steady. Even after the Soviet Union collapsed and the world briefly became unipolar, even through the 2008 financial crisis, even through wars and recessions and changes in American leadership, the petrodollar system kept humming along in the background, invisible to most people, but foundational to how the entire global economy worked. Now fast forward back to Marcus, sitting at his desk in 2026, watching that system get tested in real time. The 2026 conflict, which analysts have started calling Operation Epic Fury, didn't just disrupt oil supply, it exposed just how much leverage sits at that one narrow choke point. Iran effectively shut the strait to normal commercial traffic, starting February 28th. A ceasefire in early April briefly reopened it. Then in July, after attacks on commercial vessels, the strait effectively closed again. Through the summer, daily crossings that used to number in the hundreds fell to roughly 10 vessels a day, most moving under naval escort, some with their tracking systems switched off entirely. And here's the detail that made Marcus sit up straight in his chair. Multiple reports, including from Bloomberg, described tanker operators being offered safe passage in exchange for reflagging their vessels and paying transit tolls, sometimes in Chinese yuan, sometimes in cryptocurrency. A March report from the shipping journal Lloyd's List documented at least 2 vessels that paid a toll in yuan just to get through. Chinese analysts urged caution about reading too much into it, warning that a yuan for passage scheme would be operationally difficult and diplomatically explosive. But the symbolism landed anyway. For decades, the unspoken rule of global oil was that the transaction happened in dollars, no exceptions. Now, at the most dangerous choke point on Earth, that rule was being tested openly, in real time, with cameras and reporters watching. Meanwhile, back on the economic side, the effects of the crisis rippled through in ways that touched every American household. Gasoline prices jumped by close to $1 a gallon within weeks. Consumer inflation expectations for the year ahead spiked to nearly 5%, the highest reading in more than 6 months. The Federal Reserve, which had been cautiously eyeing interest rate cuts earlier in the year, suddenly found itself boxed in. Fed Governor Christopher Waller publicly acknowledged that prolonged elevated oil prices could have what he called a non-transitory impact on inflation, essentially admitting the central bank might have to abandon plans to ease rates. By late March, futures markets had, for the first time, priced in a real chance the Fed's next move could be a hike instead of a cut. Energy makes up roughly 7% of the core inflation basket directly, but its fingerprints show up everywhere else too, in trucking costs, in food prices, in the price of anything that has to move from one place to another, which is nearly everything. Fed Chair Powell himself noted publicly that oil and its derivatives touch the production and transportation of, in his words, many, many things. So Marcus watches all this unfold and starts asking the bigger question that's been building under the surface of financial markets for years now, long before the Iran conflict ever began. Is the world quietly moving away from the dollar? And the honest answer, the one serious economists and central bankers give when you push past the headlines, is neither a flat no nor a dramatic yes. It's something more interesting than either. Let's look at the numbers, because the numbers tell a story that's been building for a while. According to the International Monetary Fund's currency composition of official foreign exchange reserves data, the dollar's share of global reserves fell below 57% in 2025, the lowest level since 1995. That might not sound dramatic until you see the bigger picture. Back in 2001, the dollar's share of global reserves peaked at around 72%. That's a drop of roughly 15 percentage points over 2.5 decades, and the pace has been picking up, not slowing down. On the payment side, the picture looks similar. Data from SWIFT's RMB tracker showed the dollar's share of international payments processed through the SWIFT network sliding from around 47.5% in December of 2025, down to under 44% by March of 2026, a meaningful drop in just a few months. Trade settlement patterns tell an even more striking story. Nations in the BRICS bloc, which now includes Brazil, Russia, India, China, South Africa, and several newer members representing something like 40% of global GDP and nearly half the world's population, are now settling roughly 2/3 of their trade with each other in their own local currencies, up from under 20% just a decade ago. Saudi Arabia, the original architect of the petrodollar system, has reportedly increased the share of its oil exports to China priced in yuan from around 15% to over 20%. Indian refiners have made direct yuan payments for cargoes of Russian crude, cutting dollar intermediaries out of the transaction entirely. Why yuan and not rupees when India is the one buying? Because Russia runs a massive trade surplus with India, and holding a pile of rupees with limited use outside India isn't especially attractive to Moscow. Yuan at least offers broader purchasing power across a bigger economy. Then there's gold, which might be the most telling indicator of all, because gold buying isn't about convenience, it's about trust, or the lack of it. Central banks have been buying gold at a pace the modern financial system hasn't seen in generations. The World Gold Council's 2026 survey drew responses from 76 reserve managers, the largest turnout in the 9-year history of the survey, and the findings were striking. 89% expect global central bank gold holdings to keep rising over the next 12 months. 74% expect their institutions to be holding less in dollar-denominated assets 5 years from now. In the second quarter of 2026 alone, central banks added a net 289 tons of gold to their reserves, a 62% jump from the same period a year earlier, and remarkably, they kept buying even as gold prices fell 16% that same quarter. Poland and China led the buying, with Poland's central bank pushing its total gold reserves past 550 tons. That detail matters enormously because it tells you these purchases aren't opportunistic trades chasing a good price. They're strategic, structural decisions being made, regardless of what gold costs in any given month. And you can trace the real origin of this shift back to a single moment in 2022, when Western governments froze roughly $300 billion of Russia's foreign exchange reserves in response to the invasion of Ukraine. That single event sent a message to every finance ministry and central bank on the planet. Dollar-denominated reserves, no matter how large or how carefully managed, can be frozen by a foreign government's political decision. Gold, sitting in a vault inside your own borders, cannot be frozen, sanctioned, or devalued by someone else's policy choice. For any country trying to hedge against future political risk, that lesson was impossible to ignore. So what are countries actually building to replace, or at least supplement, the dollar's role? This is where it gets genuinely interesting, and where a lot of overheated headlines get ahead of the actual facts. There is no single unified BRICS currency coming to replace the dollar, and if you've seen viral posts claiming otherwise, treat them with real skepticism. Brazil, which held the BRICS presidency through 2025, explicitly shelved the idea of a common currency. India's foreign minister has stated plainly that there is no policy aimed at replacing the dollar. What is happening instead is more gradual and, frankly, more sophisticated. In October of 2025, BRICS quietly piloted something called the unit, a digital trade settlement token backed 40% by gold and 60% by a basket of BRICS currencies. The president of the New Development Bank confirmed there is an agreement in principle to use the unit as a settlement instrument for trade between member countries. But as of the most recent reporting, it remains in a prototype and pilot phase, not a fully operational currency. Alongside that sits Project M-Bridge, a cross-border digital payment system being developed through a collaboration between the Hong Kong Monetary Authority, the Bank of Thailand, China's Digital Currency Institute, and the Central Bank of the UAE, with Saudi Arabia joining the project as well. The goal isn't to dethrone the dollar in one dramatic move. It's to build interoperable payment infrastructure that lets countries settle trade without routing every transaction through the dollar and the Western banking system that dollar transactions typically depend on. Think of it less like a coup and more like an insurance policy, a backup system nobody wants to need, but everybody wants to have ready, just in case. And here's the thing Marcus keeps coming back to as he studies all this. None of it means the dollar is collapsing. Not even close. The dollar still sits at the center of a financial architecture that took 80 years to build and that no rival currency can replicate overnight. Consider the U.S. Treasury market alone. It's the largest, deepest, most liquid bond market on the face of the earth, valued in the tens of trillions of dollars. When a central bank in Indonesia or Nigeria needs to move a few $billion worth of reserves without disrupting prices, there's really only one market deep enough to absorb that kind of size without flinching, and it's the U.S. Treasury market. The euro doesn't have a single unified safe asset comparable in scale because the eurozone is 19 different countries issuing 19 different flavors of government debt. The Chinese yuan, despite China's massive economy and manufacturing base, still makes up less than 2 to 3% of global reserves, held back by capital controls, restricted currency convertibility, and limits on how freely money can move in and out of Chinese markets. Gold, for all its symbolic power, pays no yield, can't easily settle $1 trillion trade in real time, and becomes illiquid fast if you try to move it at scale. Daily foreign exchange trading volume worldwide runs above $7.5 trillion, and the dollar is on one side of roughly 88% of all of it. That's not a currency about to disappear. That's a currency with a network effect so deep that switching away from it is enormously expensive and slow for everyone involved, even countries that badly want to reduce their exposure to it. So how do you square these two facts sitting side by side? The dollar's reserve share is at its lowest point since 1995, and yet the dollar remains overwhelmingly dominant in almost every meaningful measure of global finance. The answer, and this is really the heart of the whole story, is that currency dominance doesn't collapse in a single dramatic headline. It erodes gradually, over decades, the same way it was built. Look at what happened to the British pound. At the start of the 20th century, the pound sterling was the dollar of its era, the currency the entire world traded and saved in. It took roughly 30 years, from the 1920s through the 1950s, for the pound to fade from the world's dominant reserve currency down to a secondary player. There was no single crash, no one moment where sterling lost its crown. It was a slow bleed, driven by two world wars, the unwinding of the British Empire and the steady rise of a much larger, much more dynamic American economy, offering a more attractive alternative. If the dollar is following a similar arc, and a growing number of economists think it might be, we shouldn't expect a single dramatic collapse either. We should expect exactly what we're seeing right now. A little less dollar here, a little more local currency trade there, a few more tons of gold added to a vault in Warsaw or Beijing, a pilot program for a new settlement token, A yuan-denominated oil contract here, a bilateral currency swap line there, 40 of them now in place worldwide according to some counts, alongside a payment system called SIPS that China has built specifically to give itself an alternative to the dollar-dominated SWIFT network. None of these things alone threatens the dollar's position. All of them together, compounding year after year, represent something real. This brings Marcus and us back to oil, because oil sits right at the center of this entire story, both literally and symbolically. It was the 1973 to 1974 deal with Saudi Arabia that cemented the dollar's global role in the first place, so it makes sense that any erosion of that role would show up first in how oil gets bought and sold. And that's exactly what the data shows. Back in 2023, only around 1/5 of global oil transactions were happening in currencies other than the dollar. By the analysis running through early 2026, that share appears to be accelerating, particularly under the pressure of wartime conditions in the Middle East and continued Western sanctions on Russian oil that have pushed Moscow to find dollar-free ways of getting paid. Consider the irony sitting inside just one recent episode. In February of 2026, India signed a trade deal with the United States in which Prime Minister Modi agreed to halt Russian oil purchases in exchange for President Trump cutting tariffs from 50% down to 18% weeks later after the U.S. Supreme Court ruled that Trump lacked the legal authority to impose those sweeping tariffs in the first place. Indian refiners quietly resumed and even expanded their purchases of Russian crude, this time settling many of those purchases through non-dollar payment channels. It's a small case study in a much bigger truth. Geopolitical pressure and sanctions don't eliminate demand for oil. They just redirect the plumbing of how that oil gets paid for. And every time that plumbing gets rerouted around the dollar, a little more of the old infrastructure gets left behind, unused. And a little more of the new infrastructure gets tested, refined, and normalized. It's worth pausing here to understand what OPEC Plus itself has actually been doing through 2026, because the production side of this story is just as tangled as the currency side. For most of 2025, the 8 core members of OPEC Plus, led by Saudi Arabia and Russia, had been unwinding years of deep voluntary production cuts, adding back roughly 2.9 million barrels per day between April and December. But at the very end of November 2025, the group hit the brakes, reaffirming a pause on further increases through the first quarter of 2026. Around 3.24 million barrels per day of cuts stayed in place, representing something like 3% of total global oil demand. Why pause instead of keep pumping? Because independent forecasters, including the International Energy Agency, were warning of one of the largest oil surpluses in years, with inventories potentially building by as much as 5 million barrels a day. Then, the Iran war reshuffled the entire calculation. With Iraq and Kuwait partially unable to export through a blockaded Hormuz, and with Brent crude briefly spiking above $100 a barrel during the worst of the crisis, OPEC Plus production decisions became, in the words of one Middle East energy analyst, partially academic, because the war itself was dictating actual physical supply, regardless of what any quota on paper said. Saudi Arabia, sitting on roughly 3 million barrels a day of spare capacity and a fiscal break-even price near $80 a barrel, found itself in an unusually comfortable position for a change, watching triple-digit prices generate enormous surplus revenue even without opening the taps further. But that comfort didn't last. As the conflict cooled through the summer and rerouted shipping lanes gradually absorbed some of the shock, forecasts shifted again, with several major banks projecting Brent would likely settle somewhere between $68 and $80 a barrel for the balance of the year, assuming no fresh supply shock emerged. And underneath all of this sits a deeper disagreement that has nothing to do with any single war or embargo. The International Energy Agency projects that global oil demand will plateau within this decade as electric vehicle adoption accelerates and energy efficiency improves across major economies. OPEC, unsurprisingly, sees the opposite, forecasting robust demand growth continuing well into the 2040s, driven primarily by rising energy needs across emerging markets in Asia and Africa. These aren't just academic disagreements buried in quarterly reports. They're the foundation for trillions of dollars in investment decisions and national energy security strategies being made right now in boardrooms and finance ministries around the world by people betting real money on which vision of the future turns out to be correct. Meanwhile, non-OPEC production has become the wild card nobody can fully control. The United States, Brazil, Canada, Guyana, and Argentina have all been adding barrels to the global market, at a pace that keeps offsetting whatever restraint OPEC Plus tries to exercise. American crude output hit an all-time high above 13.8 million barrels per day in late 2025, driven by continued shale drilling and expanding offshore production in the Gulf of Mexico. That's the uncomfortable bind OPEC Plus finds itself in today. Every barrel of cuts it makes to support prices risks ceding more market share to producers outside the cartel who show no sign of slowing down, while every barrel it adds back risks flooding an already oversupplied market and crashing the very prices its member economies depend on. It's a tightrope with no comfortable side to fall toward, and it's precisely the kind of structural tension that makes the currency story even more consequential, because a group of oil producers with steadily eroding pricing power has even less incentive to defend a payment system that primarily benefits somebody else's economy. Now, what does all of this actually mean for you? Whether you're an investor watching markets, a business owner pricing out your supply chain, or just someone trying to understand why gas costs what it costs and why your grocery bill keeps climbing. First, it means energy prices and currency markets are more tightly linked right now than they've been in years. So watching oil isn't just about watching oil anymore, it's about watching a proxy for global monetary confidence. Second, it means gold's multi-year rally, with some forecasters now projecting prices well above $6,000 an ounce by the end of 2026. Isn't just retail investors chasing headlines, it's central banks making structural long-term decisions about what they trust as a store of value. And that kind of institutional buying tends to put a durable floor under prices rather than a fleeting spike. Third, it means inflation and interest rate policy in the United States are now more exposed to Middle East geopolitics than they've been in decades, because a closed strait halfway around the world translates almost immediately into what economists like to call an energy tax at your local gas pump, a tax nobody voted for and nobody can avoid paying. And fourth, and maybe most importantly, it means the framing you'll see constantly online, the dollar is either invincible forever or the dollar is collapsing tomorrow, is almost always wrong, because reality sits in the much less dramatic, much more interesting middle ground between those two extremes. Marcus has come to a conclusion after months of watching this play out on his screens, a conclusion that took him a long time to reach because it's less satisfying than either of the extreme narratives constantly competing for his attention online. The real story isn't a battle between OPEC and the dollar, and it was never really that simple to begin with. It's a much bigger contest between different sources of global power, all interacting at once. Energy gives producing nations leverage, especially when that energy has to pass through a single choke point like the Strait of Hormuz that a handful of countries can effectively control. Deep, liquid financial markets give the United States a different kind of leverage, one built on trust, scale, and decades of institutional credibility that took generations to construct, and that can't simply be copied by decree. Manufacturing capacity and technological infrastructure give China and other rising economies a third kind of leverage entirely. And currencies are simply the medium through which all of these different forms of power get expressed, measured, and settled between nations that don't fully trust each other but still need to trade with one another every single day. As these forces interact and rebalance, year after year, the world doesn't flip from one dominant currency to another overnight. It becomes something messier and more layered. A genuinely multipolar system where the dollar remains the largest player on the field, but is no longer the only player that matters. Saudi Arabia's own approach to all of this might be the clearest signal of where things are actually headed. The kingdom hasn't abandoned the dollar, and Saudi officials have been careful and deliberate about that. But it has quietly diversified, exploring WAN-denominated contracts, joining digital payment infrastructure projects like mBridge, and keeping its options open in a way it simply didn't need to 50 years ago, back when the petrodollar arrangement was fresh and Saudi Arabia's economic future was inseparably tied to Washington's protection. 50 years from now, will people look back on 2026 the way we now look back on 1971 as one of the pivotal turning points in the story of global money? It's genuinely too early to say with confidence. What we can say is this: the system built in that quiet 1974 agreement between Washington and Riyadh is under more real pressure today than it has been at any point in the past 5 decades. Pressure from war, pressure from sanctions, pressure from central banks quietly stacking gold in their own vaults instead of parking money in someone else's treasury bonds, and pressure from an entire generation of rising economies that watched what happened to Russia's frozen reserves in 2022 and decided, quietly and deliberately, that they never want to find themselves in that exact position. None of that means collapse is coming next month or even next year. The dollar's advantages, the depth of the treasury market, the sheer size and trust built into American financial institutions, the network effects of 88% of currency trades still touching the dollar in some way remain enormous, and they're not going anywhere fast. But the direction of travel is becoming harder to ignore with each passing quarter. A little more gold in central bank vaults, a little less dollar in daily reserves, a few more oil cargoes settled in yuan instead of dollars, a few more bilateral payment systems quietly built and quietly tested, waiting in reserve for the day they might be needed at real scale. So the next time you see a headline screaming that OPEC is destroying the dollar, or on the other side, one insisting the dollar's dominance is permanent and untouchable forever, Remember Marcus, sitting at his desk in Chicago, watching tanker traffic collapse to near zero through a strait that carries a fifth of the world's oil, watching yuan tolls get paid at gunpoint diplomacy in the Persian Gulf, watching central banks quietly stack gold month after month regardless of price, and understanding, slowly, that the real story was never going to be a single dramatic headline at all. It was always going to be a long, slow, compounding shift, decades in the making, still being written one barrel, one transaction, one central bank meeting at a time. And the question worth asking isn't whether the dollar will survive, because it almost certainly will. The more interesting question is what kind of world the dollar will be surviving in 10 years from now. A world where it's still first among equals, or a world where equals start to matter almost as much as first